Good morning. A bank capital reset could reopen some CRE lending channels. And if you've been in commercial real estate market over the last 12 to 24 months, you already know the story. Capital tightened and lending slowed and deals became harder to structure. Now that may be starting to shift. Federal regulators, including the Federal Reserve and the Federal Deposit Insurance Corporation, or FDIC, and the Office of the Comptroller of the Currency, and OCC is their abbreviation, but they've all proposed updates to bank capital rules that could materially impact commercial real estate lending. And if you understand how banks actually price and allocate this capital, you know this is a big deal. So, what's actually changing? Well, at a high level, regulators are proposing a 2.4% reduction in the required capital for large banks, roughly 20 billion in freed up capacity. And that matters because banks hold over 1/3 of the 4.9 trillion CRE debt market and about half of the broader $6.1 trillion commercial mortgage market. And the point is, more available capital equals more potential lending activity. But the real story is risk weighing adjustments. So the key shift is risk weighting rewards stability. And the new proposal changes how banks must allocate capital based on loan risk. So the proposed new risk weight structure is, say, 60% loan to value loans, and that risk weight drops from 100% to 70%. And with the lower the loan relative to the total value, then there's less of a capital requirement, is the point. So what does this mean in the real world? Well, this is a clear signal from regulators that they're going to favor low leverage and strong cash flow, and also penalize higher leverage plus execution risk. So, why this matters for borrowers is this isn't just policy, it directly impacts loan pricing, structure, and availability. So, increased lending capacity, in theory, is what we're going to expect. And with lower capital requirements, banks may have more balance sheet flexibility, a more willingness to originate loans, but also an improved ability to compete. But, and this is the critical point, capacity doesn't guarantee deployment either. Two, pricing compression on stabilized deals. So lower capital requirements equals a lower cost of capital for the bank. And what that can lead to is tighter spreads between interest rates and more aggressive loan terms. So really focus on the best positioned assets in these categories. So we're thinking stabilized multifamily or industrial with strong tenants and retail with proven NOI. And we'll see banks regain competitive ground. And over the past few years, debt funds and private lenders have filled the gap. And this rule change could allow banks to re-enter deals they were more conservative on or compete more aggressively on pricing, but also win back market share on core assets. And four, value add still stays expensive. And here's where most borrowers get it wrong. This is not a broad reopening of credit. In transitional deals, think heavy rehab projects with high leverage, say 70 to 85%, these still carry 150% risk weighting. So they still need more capital for that. And what that means is higher capital costs for the banks and maybe less of an appetite for loans. But continued reliance on non-bank lenders in that space is important. And that's the constraint nobody talks about. Even with regulatory release, banks don't suddenly flip a switch. Their lending decisions are still driven by an internal risk appetite, their CRE concentration limits, and their portfolio exposure, but also the economic outlook. And as firms like Treps have pointed out, regulatory changes don't automatically create loan volume. And banks still want to have to lend, and strategic takeaways for borrowers. So this is where strategy matters and where most borrowers can lose. And if you own stabilized assets, you're entering a more favorable lending window. And we hope to see improved terms and competition for deals. And now is the time to review refinance or acquisition strategies. And if you're a value add investor, nothing structurally has changed for you. But expect continued reliance on bridge loans, debt funds, and structured capital stacks. And the point is, your edge is the structure and not the rate. So if you're planning a deal in 2026, let's underwrite based on today's credit reality and treat any improvement as upside, not an assumption. We're going to focus on DSCR strength, conservative leverage, your exit flexibility, and the bigger picture for you as an investor. And this proposal is a structural tailwind, not a bailout. What it does is it improves capital efficiency, lending economics, and competitive dynamics, but it does not override risk discipline. The bottom line for today is that the bank capital reset is good news, but only for the right deals. And stabilized low leverage assets will be the ones that benefit the most. And pricing may improve as competition returns, but value add deals will still require creative financing. And this is not a lending boom, it's a selective reopening. And in this market, structure still beats rate every time. That, my friends, is it for the day. Please visit my website, billrapponline.com, to figure out how to get a hold of me. Love to talk to you more. Have a good day.